Hey everyone, welcome to the KE Report and a daily editorial. I am chatting with Darrell Fletcher. Darrell is the managing director of commodities at Bannockburn Capital Markets. Darrell has set up the commodities trading desk over at Bannockburn, so I bring him on every month to more or less get an update on what he's seeing in terms of the bigger markets, commodities markets, especially energy, but we're also going to get into the metals sector, precious metals especially, because gold has been continuing to do quite well, and copper's seen a little bit of life recently that has faded. Again, Darrell really provides us with insights in terms of what sort of hedging is going on and where a lot of the larger money is getting positioned. Darrell, before we start off, just a broad comment on commodities. To start this year, commodities have been fairly strong. Now, I'm sure there's a number of reasons we can point to, but one continues to be these ongoing tariff fears or tariff wars that can put a damper on supply, especially the fact that the US seems to want to also go after China, and China controls so much of the supply of individual metals here. Darrell, what are your comments on the start of the year? We're almost 2 months through what we've seen in the commodity sector broadly.
Yes, thanks, Corey, for having me on. Yeah, I'd agree. For commodities have been generally very constructive, and it's not only been constructive year to date, but it's been broad-based for the most part. I look at Bloomberg Commodity Index, Bloomberg Spot Indexes, they're both up 7, 8% on the broad commodity index. Energy, 8%. So in the LMEX, base metals, 7%. So it's been strong, and a lot of those moves year to date, I would say at least half of it's been in the past month. Couple macro things. There's been definitely some speculative money coming in on this constructive due to the tariff situation and just general unknowns. And we can talk later about basis differentials, especially in metals. It's been fascinating. And dollar has been weaker. Year to date, you're down about 1.7% on the index. So, nothing huge when you're used to trading commodities. But yeah, it's been constructive and impressively broad across most commodity categories.
Dale, what about China? Any maybe strength we're seeing out of China? They can be major drivers behind metals prices because of how much they accumulate. What's your take on China's role in potentially helping this good start to the year for commodities?
Yeah, I think definitely there's some of that. It hasn't been as weak as possible, or has it been last year. So we're seeing some of the general manufacturing numbers starting to trend up. I think some of it's still hope, but you're seeing it in copper for sure. Oh, the gains in copper. You're seeing some nice gains in iron ore year to date. Iron ore is still holding 107, and hot rolled coil steel. So those kind of big picture commodity metals that China can have an effect on have definitely been reflecting that. And some of the data, fundamental data, has been better, not crazy good, but it's definitely been better.
Daryl, what about this whole concept too of what we hear of what could drive certain commodities, albeit it's a wide range of commodities, is AI buildouts, data center buildouts, and also this whole electrification narrative. It's almost got thrown on the back burner recently with Trump in office and him slowing down some of these green initiatives. But fact of the matter is, these two, the AI data centers and the electrification build out, been really a pillar of commodities bulls saying this is why we need more commodities. This is why commodities are going to do well. Are these key drivers in your eyes?
Yes, it's fundamentally still in play. Good point. I think the tariff situation with Trump has taken the headlines, but in the meanwhile, and we can talk about the copper forward curve, despite the moves up, is still in contango. That's really constructive. Like you typically don't see that in a commodity curve. I mean, it's a critical mineral, so infrastructure, EVs, power, that's not going to change. I think a lot of the tariff situation has, as I talked about, I think last month, it's more of a basis differentials coming into play in speculative positioning, but it's also really put a damper on what I call neutralizing capital flows and confidence around that. So some things have probably been put on the back burner as companies decide where to invest and outlay capital, but fundamentally those things haven't changed in terms of the use of copper and infrastructure in general.
All right, let's get into individual commodities. We always like to start with the energy commodities, starting with oil. Oil has been relatively boring, continues to be largely range bound between, let's say, $80 and $70 this year. Last year, for almost the back half of the year, it was between 80 and, let's say, $65. Right now, oil is testing that $70 level to the downside. What's going on with the oil market here? Any light at the end of the tunnel to see some sort of a break, either higher or lower?
Yeah, good point. It's been pretty boring, and it's kind of done what I thought it would do so far this year. All the way, we have 10 months to go. I kind of said I think we're going to be range bound to grinding lower, and that's kind of what we've seen. We've had 5 straight down weeks on WTI pricing. Nothing, no big moves, but just kind of grinding lower. Brent's, 75-ish now. WTI, as you mentioned, barely holding on to 70, and it's been teetering there, really back into the fall, to your point. The 100-day moving average fell off last week. That got taken out. So I wouldn't be surprised to see it test 70. There's no real fundamental driving exciting news in crude oil right now, and that's kind of why we've been in this boring situation. I think the next big piece of information, which could come as early as early March, would be what OPEC Plus does on this increasing production. It's like 120 to 130,000 barrels, I believe. That decision has been put off 3 times. This would probably be the fourth time, and I anticipate that probably will put it off again. Maybe push April up to June or July. That's kind of the biggest piece of news that's still sitting out there. And that could come out, like I said, in the next few weeks. Other than that, you're just watching inventories, but there's just kind of demand and supply uncertainty slash neutralization, and you're seeing that in the pricing actions really slow, especially for crude oil.
What's your take on US production? Because that's one thing I think that's holding back some traders is that I hear the bears for oil saying, look, Trump is going to encourage drilling. That's going to bring up US production, which is already at very high levels, considering how few rigs are actually turning right now. But there's also the bulls in the oil space saying companies aren't just going to increase production because Trump wants them to. They want higher prices to increase production. Where do you stand on this bull bear argument when it comes to US production?
Oh, I agree. I mean, I think the oil and gas producers have been disciplined. I don't see that changing. And again, I think a lot of this stuff right now is headline driven. Yeah, to your point, the rig counts are down. I think they've been disciplined. There hasn't been a lot of investment, like, in oil and or gas in terms of production, second half 24. So that's been in check. But demand's been light also. So I think you just have this neutralization on demand and supply. Now we have seen big demand in distillate fuels here in the US in the past few weeks, and that's in line with natural gas for heating oil use. So distillate demand peaked, I think, seasonally like an all-time, maybe a 3-year high the past couple of weeks on distillate pull. So that makes sense. And that's not a reflection of crude oil or refining issues or anything like that. It's just more of an issue reflective of heating oil demand and distillate stack.
On the hedging front, are you seeing any changes in terms of companies trying to lock in some sort of pricing moving forward?
Yeah, we're seeing, I mean, your crude oil is still backwardated, not as much, 66 for Cal 26 on WTI. So there has been some interest out there. Some of the interest in hedging diesel fuel has faded because it was around 2 wholesale, but it's ran back up just on this distillate pull for heating oil. So yeah, I mean, you still have some backwardation, which is impressive given the fronts just kind of keep grinding lower.
All right, let's talk nat gas then, because nat gas has been generally more interesting for pretty much all of 2024. Nat gas really topped around, let's say 350, I guess. That's when it spiked. Sometimes it even got into the $1.50 region, but it's been generally higher priced throughout this year. January, mostly a flat month, except for a sell off at the end of January. And February, almost straight up for nat gas over $4, now pulling back right to that about $4 level. Look, I know nat gas is driven so much by cold weather. It was cold for the last about month and a half, kind of around North America. what's going on in the nat gas market? Do you think we've seen a at least short-term top from that run this month?
Hard to tell. I mean, as boring as crude oil has been, natural gas has not been boring. It's been really interesting. You have four factors. One kind of leads to the other. But below normal temperatures, we got off to a really mild winter. But then January, February, to your point, have both been well below norm. Like we're finally starting to see some temperature change to norm to above norm, but not till mid-March. So these last 2 weeks, well, last week of February, first week of March still looks fairly cold. So you have below normal temperatures, inventories down across the world, and I'll go through the stats on the inventories. It's interesting. Production, which 104, 105 here US, has been hit because of these freeze-offs on these well below normal temperatures. Bakken, Mid-Con, all the way down to Texas. So you had a few days last week where we were falling just below 100 BCF a day. Combine that with LNG exports hitting new highs. You're taking deliveries of LNG exports at the terminals hit 16 BCF last week. So you do the math if you have some days where you're pulling 16 out and your production's down below 100. That's a chunk. 4 or 5 years ago, we didn't have those kind of impacts from LNG, and it's there. So I think that's why we've seen a really nice spike in the front. Now March rolls off this week, the contract into April. But April's trading around the same level. We had a little bit of a sell-off today because the temperatures finally looks like they're coming back to normal, but April's almost $4 also. Summer gas has spiked up into the low fours. So inventory is a big issue right now. Really big issue. You had some spot natural gas days last week that were $7 plus on Henry Hub.
Darrell, is this going to lead to an increase in U.S. production then? Is this a good enough nat gas number to actually entice some more companies to produce more, or do they quite simply just need $5, $6, $7 nat gas
It
prices?
should be. I would agree with that. I had this discussion the other day, but they've been disciplined. They're not going to jump right back in. I know some of the numbers I saw from second half 24, not huge increases, and I think they're going to, walk slowly into that situation. But you would think so. This would start to turn some more rigs on and release some more gas into the market. Inventories are interesting. We can run through that. U.S. inventory, this is through last week's numbers. I think we're below 16% below prior year and about 5-6% the 5 year. European gas, if you're looking at the TTF as your marker, you're down about 44% year over year and 22% over the 5 year. And even Canadian, at least to the east, storage is down 40% year over year and about 13% on the 5 year. Canadian West gas is pretty flat in comparison, but globally, your inventories are down, whether you're looking at year over year or the 5 year. We're up. The front contract's up about 130, 140% year over year. We had some pretty cheap gas coming out of last winter, so it just really marked a marked difference in weather that we were seeing.
Look, we have a lot of US and Canadian listeners, and we keep hearing the differential in terms of pricing for a lot of these Canadian companies, especially in natural gas. You do any research in this, Darrell? What are you seeing in terms of maybe these differentials just between US and Canadian pricing coming more in line?
Yeah, and there's still a big differential to it. I don't follow Canadian gas as closely other than looking at the storage numbers as opposed to the US gas. You definitely had some move up in ACO, but that's kind of consistent with what we're seeing here in Henry Hub too, and consistent with the inventory numbers.
Okay. Let's move over to the metals then, especially gold. Gold has been impressive ever since the breakout back in March of last year. We're almost a year into this run now. Gold's been hitting all-time highs quite consistently. It's been doing quite well to start off this year. Darrell, on a commodities trading desk standpoint, what are you seeing in terms of interest into gold? The type of players that are now entering the gold market, anything noteworthy that we should be paying attention to?
Yeah, I mean, it's been a pretty consistent move up. Again, I thought it would be constructive this year. Both gold and silver are up around 12% year to date. And both of those, a lot of those moves have happened in the past month. So it's been pretty consistent move higher. I know the gold ETFs are seeing really large inflows. And the things that I talked about in January around lack of confidence, and it's still in play. I think we hit a new high today. You have to think technically that gold's going to push for 3,000 just to see what it can do up there. And in dollars, yeah, it's I'm kind of surprised it hasn't made a move, like an intraday move, but probably need one of those days of high vol and lack of confidence and comments or something coming out. You have, the dollar, as I mentioned, is off year to date, 1.7%, but gold and silver both up 12. So it's been pretty constructive, kind of what I thought coming into the year so far. It's played out.
Noticed anything in the commitment of traders reports in terms of who's short, who's long, those type of metrics?
I haven't seen the details on those, just other than some of the notes around the gold ETFs, the inflows hitting really high levels.
Now, we've also heard about this gold coming to the US from overseas. Look, we hear about these flow of metals, also people tying in the potential tariffs. You reading anything into these stories?
Yeah, there's definitely been physical flows of both gold and copper coming into the US with all the tariff talk. So physical flows are coming in. It's been constructive for both. We're seeing a lot of really interesting things on the base metal side, on just like I said, the basis differentials globally ahead of tariff. A lot of this stuff's still very unknown. I mean, if you look at the things that are supposedly in play here, if you look at specifically steel, aluminum, those are supposed to go into effect March 12th, but we shall see. March, 2, 3 weeks here seems to be a long time for things to change right now.
Boy, does it
A
ever.
lot can
We have seen that.
happen.
Yeah, absolutely, especially on this tariff front. What about copper then? Copper has been doing a bit better this year, as we outlined in terms of the broad commodity complex. But as we're chatting, copper right around 450. Look, copper has been, in a way, kind of widely range bound as well over the last year or so, but it is at a generally higher price than we've seen in history on a more consistent basis. Is copper due for a big breakout here, or is this more or less a new pricing model, somewhat above $4 for copper?
Yeah, I'd agree with the latter. It's been a nice move up this year so far. I'll get into the difference between COMEX copper and LME copper again on the tariff global differential situation. That's been pretty fascinating. We had a record differential there past week or two. So yeah, and it's higher. I think we're at a higher level. And what's been really impressive, if you look at COMEX copper, you're up 12% year to date. LME copper's up 8%. That was wider. But copper making a nice move like that, it's still contango curve. You still have a forward curve that's higher. And you typically wouldn't see that in a market that had moved that high that quickly. So you get out into 26, 27, you're in the 370s, 380s, as opposed to your front month March, May contracts are around 450. So that's impressive. I think it's very constructive. And that tells you a lot there also.
How long do we typically see some of these markets in contango, where, again, it's the forward months being priced higher than the current month?
Well, if all things like a commodity market, if all things are equal, there's nothing like supply and demand isn't way out of sync or anything. Just the cost of carry, you're going to have a naturalized contango market. Where you see big differences are like when there's big run-ups in the front from a supply shock, especially you can kind of see that natural gas where it can flip into backwardation or contango pretty quickly, just depending on what the front's doing. But I think the copper forward curve it tells the story in terms of it being constructive going forward. And that differential I was talking about is the most interesting thing I've seen in the past month. The COMEX, let's just call COMEX front month to the LME 3 month. You've got a couple months there technically of time, but that typically runs 3, 4, 5 cents. That blew out last week to 1,200 a metric ton, over 50-cent differential. COMEX over LME. Today we're back to about 20 cents, but it's still very high. And that really is reflecting the tariff risk. And think about it, there are no tariffs named specifically for copper yet, but the potential is in play, and the market's reacting accordingly. I know we have seen more speculative money coming into the copper side too. It's a really volatile trade, the COMEX copper front month right now.
On that topic of some different money coming into the copper trade, if we bring this full circle to commodities, Boy, oh boy, I've seen in the last 10, 15 years these charts of just how much financial assets have more or less left behind hard assets or commodities, if you want to be specific. Do you see a change in that narrative where investors are warming up to commodities more than just for a short term trade?
I do, and maybe I'm biased. I've been doing this a while, but and I think what's interesting, we started this conversation talking about the general move up in commodities, but it's really broad. Like you're seeing it this year, where whether it's base metals, gold, silver, crude's been boring, energy complex across the complex has been constructive. It's you look at the spot Bloomberg spot commodity broad index, energy index, they're all up this 7-8%, and you have your precious metals up 12%. So far this year it looks constructive. It's broad. The tariff situation is creating some really interesting global differentials, particularly in the metals market, copper, aluminum, steel. And back to that point, you're seeing finally some pickup even in the real macro metal markets like iron ore and steel. They're also up this year. So it's been a good move.
So could be a good year for commodities. At least they're off to a solid start, something that we've covered throughout the first pretty much 2 months of this year. Just looking for the outperformers right now, which have been the precious metals, but as you outlined, a lot of commodities doing well in unison. Darrell, always great chatting with you. Again, Darrell Fletcher, Managing Director of Commodities at Bannockburn Capital Markets. Really appreciate your insights on the commodities sector here, Darrell.
Great. Thanks, Corey.